Welcome back to the deep dive.
Good to be here.
So today we've got this interesting bit of advice. It's from Miss Mansi's vault, focusing on stock market investing.
Hmm.
And our plan really is just to unpack it, see what's valuable there for, anyone looking into financial growth. Doesn't matter if you're experienced or just starting out.
Yeah, and what struck me immediately is how it looks simple, but it actually hits on some pretty deep stuff like investor psychology, risk management fundamentals.
Okay, let's get into it then. The first bit says start with small position size and never average the stock down.
Right.
So straight off, caution seems key. Don't bet the farm on one thing.
Exactly. Test the waters.
And that never average down part, that sounds pretty firm. No buying more if it's already losing value. Why is that such a big deal?
Well, it taps right into, how our brains can work against us sometimes. There's this urge, right, to double down when you're losing.
Yeah, I hope it comes back up.
Exactly. You hope to lower your average cost and break even faster, but it's often a trap.
A trap how?
You're essentially pouring more money into something well, it's already proving you wrong, in a way.
Okay.
It feels like getting a bargain, maybe, but you could just be digging a deeper hole with a fundamentally weak investment.
That money could be somewhere else, right?
That's the opportunity cost, yeah.
Yeah,
It could be something that's actually working.
got it. Okay, so the next part follows on. You add only to the winners and never let this position to turn into loss.
This is the flip side.
It feels different. Not the usual buy low, sell high mantra, maybe. Adding when it's already up.
Right. It's about momentum. If a stock's doing well, something's likely driving it.
So you're trying to capitalize on that existing strength.
Yeah, you ride the wave, essentially. Amplify the gains you're already seeing.
Yeah.
Think of it like giving more resources to your best performing project.
Makes sense. But the second part, never let this position turn into loss. That sounds like discipline, hardcore discipline.
It absolutely is. It screams, have an exit plan before things go south.
So you've made some profit.
And you need the foresight, the rule to say, okay, I'm locking this in. I won't let it evaporate.
How do people actually do that? Practically speaking.
Well, it comes back to strategy before you invest. Maybe setting a stop loss order.
Right, the automatic sell trigger.
Yeah. If it drops to a certain price, you're out, profit protected. It forces you to act on rules, not, hope or fear. Takes the emotion out of it, or tries to.
Okay. So for you listening, if you like things clear and not overly complicated.
This framework seems pretty direct.
Yeah. Be careful initially, small steps. Don't chase your losses.
Focus on what's actually working there.
And have that line in the sand to protect your winnings.
Exactly. And if you zoom out a bit, it's also about learning, isn't it?
How so?
By adding to winners, you're kind of reinforcing what's working in your strategy right now. You're saying, okay, this approach has merit, let's lean into it.
And cutting losses.
That reinforces adapting, being okay with admitting, all right, that initial idea didn't pan out, move on, don't get stuck.
So wrapping this up, this advice from Miss Mansi's vault. Start small, don't average down losers, add to winners, protect those profits. It's quite a neat package.
Very focused.
Which leads to a final thought for you to maybe mull over. This core idea, managing risks carefully, cutting losses quickly, but doubling down on what's successful. How could that principle apply beyond just stocks? Think about other areas in your life, career, projects, maybe even relationships where you're aiming for growth. Where could you apply that same logic?
Yeah, manage the downside, maximize the upside. It's a potentially powerful lens for looking at lots of things.
Something to think about. Thanks for tuning in to The Deep Dive.